Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
Hey everyone, welcome back to the Share the Wealth Show. This is where we deep dive into the tools and strategies that help build lasting wealth for our families and communities so we can help build, grow, and protect minority wealth. Today, we're actually doing a mashup of a couple of our popular episodes that tackle a crucial but often misunderstood topic: cash management strategies. Many people overlook the power of treasury management, index options, and infinite banking, and they end up missing out on opportunities to grow and protect their wealth. Here is the truth: building financial freedom is within reach, but it starts with the right knowledge and strategies. So, in this episode, we're breaking down how to use index options and treasury management to outperform traditional financial planning with Aubrey. And then we also dive into diversifying assets and gaining tax advantages through cash value life insurance with Eunice, and then leveraging family banking for greater flexibility and effective arbitrage with her husband, Lee. So whether you're just getting started or looking to enhance your financial plan, this conversation is for you. So stay tuned. This is the Share the Wealth Show, where financial empowerment begins. Let's go. Hey, Aubrey. So how do you prioritize building an emergency fund versus actually using that money you've saved to invest in something?
My success fund will give me more success and more opportunities. So my success opportunity fund. So whatever I invest, I also have it in capital cash to where I'm going to invest that over. So in the event something happens over here, every 30 to 90 days, I'm going to deploy capital, period. The question is, where is it going to go? And what's the number that's going to go there? So I dwell very heavily in index options and treasury management, which most people do not talk about. It's also something your financial planner will not tell you about because he or she will not receive a commission from it. So they don't want to take their fees away because that takes food out of them and their family's mouth. But I dwell in that very heavily. So when I'm not, quote unquote, acquiring an asset, I am growing my capital and building my bank. So I'm very big on building my bank, teaching others and showing others how to build their bank, letting them leverage my team and or my capital to where they can build their bank and we can do more good together, because it's important to be well and wealthy. Because if you're wealthy, you're going to be wealthy.
So how does using treasury management as a strategy give you an edge over traditional investments?
So it's just one of those things where if you're getting a success fee on the back end of me getting my 6% or plus, the same way you would in an actual, say, a syndication or whatnot, it changes things. So for me, in treasury management, it allows me to move differently. I can do project financing with it. I can become the bank with it. I can deploy my capital. A lot of people deal with 529s for their kids, for their insurance and things of that nature. I can utilize my brokerage account to leverage that. Then I have a whole team in place that does it as well for me, that's looking at the market 7 days a week. So when you talk about the education component of it, I'm not sure if he's referencing index funds or an index option. Index option is a 30, 60 to 90-day contract. Usually we do a 30 or 60-day contract and you receive dividends over the course of the 90. And then you can determine if you want to cash out the dividend or if you want to throw it back in. Now that's night and day from investing passively in an investment with someone else and then them telling you got 12 months before you receive your first distribution. I know every 90 days, I'm going to once a month meet with the team, or sometimes twice a week, because there was so much going on, at least the last quarter. We meet on a regular. And then with our network, we meet once a month. So they know what's going on with the market, how we've chosen this contract over that contract, and why we're buying these contracts whole time wise. It's kind of like when Apple bought Beats. They bought it at the top of the market. The reason they bought it at the top of the market is when the market circled back around, it was so they could control the market. And if I can control my investment, that's what I'm going to choose to do. I think we all would agree on that. So that's why that's my little safe haven for me. when it comes to an index option in our treasury management.
How has leveraging your W-2 job helped fuel your entrepreneurial journey?
I learned very quickly that a lot of individuals, they're not that smart. Some people they're not. Even I always say, if you're lazy and lie, you're probably lying to yourself saying you're not lazy. So you're already in the same boat. So for me, I always knew I wanted to make sure I had a capital partner. So I want to be very transparent that I absolutely have a capital partner. When I say capital partner, I mean a job, a W-2, and I leverage it very heavily. So where I only work sometimes 4 days a week, and I get paid for my time off as well. So I'm leveraging it, and I'm going to a conference, I'm investing in some more assets and things of that nature. But as far as entrepreneurial wise, I remember at 7 autographing things because I knew 7 was a number of completion. At the time, I didn't know, but I was autographing things because I knew I would be doing something. At 8, I remember telling my mom, hey, Mom, I'm going to draw out my stuff because I'm going to have my own clothing line. And then I'm going to put my brochures together of how I want to have my businesses. I literally went back and looked come middle school, all those drawings, I enhanced them, draw out my logos, etc. And all those things are things that I'm doing today. And I would say a lot of that had to do with my mother because she was an entrepreneur as well. And she also had a job. And at some point in time, she realized I need to do more of this so I have more time with my kids. And when I saw how she was doing certain things, especially my grandmother, they were very good at what they did and they still made time for everyone else around them. So I come from an abundance-minded family, an entrepreneur-minded family that all leverage their capital partners, which were their jobs and W-2s, to be the best version of them every single day, but they didn't let it take over their everyday lives. Because I don't know anyone that wouldn't agree with this statement that being an entrepreneur is much harder than having a W-2 job.
Yes.
Because you do not know what's going on the entrepreneur side, regardless of what aspect you go into. But as far as your job, even when you know, oh, today, here we go. That's why people ask me, it's always a great day to have a great day. You keep telling yourself that. And I say, and I will. And you go on your day however you see fit, because I'm going to control my day because of that entrepreneur side of me. So I don't go in with the consumer's mindset to anything. I always go in with an investor's mindset. How can we do better? How will we do better? And what we need in place to make this the best it could possibly be. And think positive the same way you choose to not think positive.
What's the first step for someone who's too overwhelmed with various investment options?
And we don't want to go over anyone's head that was thinking about getting into investing and different things of that nature. And that shiny object syndrome starts to pop up. And it's important, you and I both know this, to truly build your bank, because you can run out of capital very quickly if you're not a part of a network or value teamwork and you're used to going at it alone. So having those different opportunities and their networks where you can actually trust what's being done, how it's being done, and see how it's adding value to you as opposed to overwhelming them with information that makes them want to go jump at something else before they actually get into their first step. I always check myself on that every 30 days. What are my needs? What are my wants? What are my desires? And then I have priorities. Most people have checklists and tasks. I stay away from checklists and I stay away from tasks. Priority is a very firm word. So when most people have their why, it's usually about the people that are priority about in their lives. So if you have a priority and then you have value, then you have time. So whatever your priorities are, that's what you value, and that's what's going to get your time first. So usually that's probably where your capital is going to go first as well, because the first part of capital is the time capital, and then the actual capital that's being deployed, that's actual cash, credit, or debt.
Looking to build wealth with real estate? Are you all tapped out on YouTube University and ready to get help tailored to your specific situation and goals? Have you always known that you are a little different from the crowd, that you never liked following the status quo, and that you're just tired of living in mediocrity? You want to build wealth on your own terms outside of Wall Street? Well, then maybe the Microfamily Mavericks mentorship program can help with that. It's a community where I handhold you through the process of buying your first small commercial multifamily building, because not everyone is ready for 100 units out the gate. Why multifamily? Because it gives your rental income a hedge against vacancy. Imagine what happens when your single family rental tenant leaves, right? And why commercial 5+ units? Because you have much more control over increasing the building's value in the commercial space, and then in turn, increasing your own net worth. starting small is a stepping stone to so much more, because then you can tap that equity and buy another building and another and another, and you get the point. So increasing your cash flow and your ability to be job optional along the way, it's all a part of the journey. So if you think big, but you want to start small, and if you know multifamily real estate is the way for you to open the door to building a life of freedom, abundance, and legacy, but you just need someone to guide you step by step, and you want to be surrounded by other people on the same journey, doing the same thing, then just click the link in the show notes to find out a little bit more about the Microfamily Mavericks. And I look forward to potentially seeing you on the inside. So now back to the show.
What benefits do cash value insurance have that a typical insurance policy doesn't?
And how I would like people or your audience to view cash value insurance is that for us as a family, on a yearly basis or 2 times a year, we sit down and we work on our personal financial statement. And when you look at your personal financial statement, you'll realize that it's built up largely based off of your assets and your liabilities, right? Now, when you look at your assets, there are so many options there. So what I want people to grasp is, okay, when you look at all the possibilities of assets out there, where is it that you find that you have investments or you have assets class, those asset classes? And what are you doing about the other asset classes that you don't have? Because a lot of times you find that people will say, okay, I have money, I've got savings. Okay, that's one. What else? Right? Oh, I have a 401k. Okay, what else? And they're like, oh, that's about it. Right? So when you sit down and look at your personal financial statement, you will realize that there are so many possibilities. And all we're saying is that you have to be in a position where you don't necessarily have to do everything, right? But you have to have investments in at least a number of all those to make sure that you are really fully set for your future. Now, insurance, a lot of times when we talk about insurance, a lot of people just think, okay, you are talking about leaving money for my beneficiaries when I pass on, which is correct, yes, right? But there are other advantages, or there are other avenues that are available that are still through insurance, where you have the ability to enjoy or to have both those death benefits as well as living benefits. And that is where whole life insurance comes in. Whole life insurance or cash value insurance that has been set up appropriately for your needs is going to cater for that. You are going to enjoy both living benefits as well as death benefits, right?
So living benefits, that means when I'm alive.
Yes. So basically living benefits takes away what you hear a lot, where people say, well, this means that only the people who are left behind once I pass on are the ones who are going to benefit. But a living benefit is saying, as you are alive today, you can start reaping those benefits. And those benefits are what we call the cash component of your cash value insurance. Those are benefits that you can today, as Nicole said, you know what, I need financing, or I need to do a couple of projects. Where can I go to get assistance? You don't have to go anywhere. You can use your own living benefit to use that. And that's what we are looking to educate people on, to say, you can use that today. You don't have to die first.
How does cash value life insurance compare to a 401k in terms of long-term savings and tax advantages?
And what I like to say with that one also, Nicole, is that Rome was never built in a day. So I don't want people to have the perception that, okay, if I'm going to do a whole life insurance, I want all that cash in a year or two, right? That is a wrong perception. The same way as you have I've been an employee before, right? I had a W-2 before. And even though I had that job for more than 15 years, in that time, I can genuinely tell you the savings that I was able to maintain or keep in my accounts does not compare to the savings that I was able to do with the whole life insurance policy. And I can elaborate on that a little bit later. The point here is that there's a saying, I forget how it goes, that all great or wonderful things take time. Nothing is just going to happen in a twinkle of an and it's there for you. Now, the other thing that I also want to talk about, where a lot of times you hear people say, well, why don't I just max out my 401k versus doing cash value life insurance? A couple of things. Whenever you are looking at doing a cash value life insurance, one of the things that I will sit down with you and look at you is run the numbers for you and with you so that we can understand how it fares. You putting more money towards a 401k and you putting a portion of some of your funds also into whole life insurance. And the way that works is that a lot of times there are people who, once you max out, your employer matches what you're putting out, right? And you'll find that that amount of money, right? If we were to calculate, okay, let's just do hypotheticals. If right now your employer is putting 5, you are putting in 4, and that's the whole amount that you're putting in towards your 401k. What we look at is, when we run the numbers with you, we look at to see, okay, if you put that same amount, or if you just go with just the max or a certain portion of that, and then you use some of the amount that you would have put towards your 401k into your cash value life insurance, and then give it 5 or so years and see which one has accumulated more. It's all in the numbers. You will see that for yourself, and then you can make that decision as to, does it make sense for you? Now, it's good to have both. I'm not saying don't put money into your 401k, but you also want to look at the returns for both and just look at how both are performing, right? The second thing that you want to look at also is that realize that with a 401k, you will get taxed once you start drawing that money. A lot of times people will say, well, I'll get taxed, but I'll most likely be at a lower rate versus now when I'm a full-time employee, which is correct, right? Now, when you look at your cash value insurance, one, it has deferred tax. So what that means for you is that you are able to grow that money even more, right? With that deferred tax. So instead of you being taxed right now, you know that you will be taxed later on. And if you apply and use it correctly, you can potentially not even be taxed. And here's the thing, here's why. Because when you use your cash value, when you use those funds, you are using a loan. You do not get taxed on a loan.
How does borrowing from a mutual insurance company differ from taking a loan from a traditional bank in terms of interest rates and dividends?
Now, when you are taxed, that interest, that means that mutual insurance company is making some kind of profit. But because it's not a shareholder sort of entity, it's more of a mutual. What that means for you is that when a dividend is declared, you also get a part of that dividend. So you are paying that interest for you to get that little portion back to you in the form of a dividend. Whereas when you go to a bank is never going to share its dividends with you, right? So the only people who get to benefit in the dividends are who? The bank the shareholders, the like, not you, right? The other thing as we are talking about these loans as well is that a lot of times people also question, okay, if I go and get this loan, how long does it take? What's the process? How does that work? Now, the wonderful thing about getting this loan from yourself is that, one, there is some paperwork to fill out. And the paperwork is because there has to be a record that, yes, funds have been pulled out of things of that sort. Whereas when you go into a bank, you fill out an application form. And just because you filled out an application form does not mean that you're going to be accepted, or you may be accepted, but then they'll tell you, well, your credit is not as bad as great. So instead of getting 7%, we can give you this money at 10%, right? And it usually doesn't happen in about 24 to 48 hours. Whereas when you do it with your family bank or with your cash value life insurance, usually within 24 to 48 hours, you fill out the paperwork, the money is deposited into your account. So there's all these other benefits that you're really enjoying, unlike if you were to walk into a banking institution to go and request for a loan. Nobody's going to say to you, how are you going to pay it back? You have to pay it back by paying me $1,000 every month for the next 24 months. And if you don't make a payment, I'm going to charge you a penalty for that. When you've done a loan from your cash value life insurance, you determine when and how you want to pay it back. Nobody's going to specify that for you, right? So those are some of the other benefits that keep coming up to just show you that the difference between this concept versus going into a banking institution, there's just all these advantages that you get to really enjoy right now versus saying, well, I'll still stick with going to the bank because the bank will always give me a loan. Yes, they'll always give you a loan, but you have to look at the differences and see in the end who is benefiting more from this loan even.
In what ways can changing the perception of life insurance transform it from a mere expense to a powerful financial asset?
About it that I find interesting also is that when you put an application for FAFSA, you don't have to disclose this. So it doesn't work against you. So some people will say, well, when I fill out these forms, then it shows that I have 20,000 or 50,000 in my cash value. You don't have to disclose this. It's an insurance policy, right? So it doesn't in any way increase what you have out there, such that if you are looking for a loan, they're going to consider it and say, well, you already have this, so you can't qualify for that. There's just so much. You just need to fully understand it and find somebody who can help you navigate all these questions and things of that sort to really see that there is absolutely no way that you should be there and not have something like this. I sometimes say to myself, oh, I wish we had found this earlier, but when we found out, we took a step, right? We didn't hesitate. We just knew that at this point, we just need to find somebody to have these conversations with. We started reading up just to understand how everything works versus going back and saying, well, how come I've never heard about this? And then letting that limit you, right? There's a lot of people who will say, well, I've heard about this. Well, insurance is never great. Insurance people are all terrible. Yet, right now, most people have car insurance. Well, everybody has car. When you have a car, it has insurance, right? And most people don't think twice about it. They know that car is not going to be allowed out on the roads without insurance. What more about your life? Like, how can you not value your life so much to the extent that you feel, well, maybe this is not for me? If a car deserves or is worth being insured, What about you, your life? You have to think about yourself and say, I am as valuable and I am as deserving to have some kind of insurance or to have some kind of benefit that I can even enjoy right now, and make sure that even my kids or my beneficiaries in the end have something. Just as a side note, every time I sit and I see a GoFundMe being set up for someone who just passed, it literally breaks my heart, because I know that there are options. Like, not everybody, yes, is going to be able to, right? But there are options where sometimes people would say, well, if you had only put in an extra $100 just to make sure that you are all set, right? So, have those conversations, just so that you are not one of those people who are going to have to set up some kind of a GoFundMe because, somebody just passed and we didn't think about securing someone's life.
Are you enjoying this episode? Then stop what you're doing right now. Head over to Apple Podcasts and leave us a rating and review. It really helps our show get pushed to more people who are looking for the information that we're sharing here. We have to share the wealth. If you listen to us on YouTube, make sure you like the episode that you're listening to right now and subscribe to our channel. Then share the channel with somebody else. There are people out there looking for the information you're listening to right now. So make sure you share it with someone who you know needs it. Now, back to the show.
How does leveraging a cash value life insurance policy offer more flexibility than a 529 plan for long-term financial needs of your children?
Because the one misnomer that is out there is that you shouldn't contribute to your 401, or this is a vehicle in an alternative to that. I would say that the cash value component or the life insurance component is a saving vehicle, not an investing vehicle, right? So having had a W-2 before, I would say you want to maximize what you're contributing to your 401k, right? I would say if there is another vehicle that you have, you would want to maximize those at the same time, even if it's going to be a Roth IRA, right? What I would say is that if you had to do like a 529 plan versus going with a cash value plan, I would recommend that you go with the cash value plan, because if you were to do a 529, that's going to be with your child, right? And if they use the monies to go to school, fine and dandy, but what happens if they don't, right? With the cash value component, I understand the new legislation is that the 529 can convert over to a Roth, right? But that means that those monies will not be accessible until they're 59 and a half. However, if they had leveraged a whole life insurance policy, they would be able to leverage that cash value component as and when they decided to use it. So it's not really apples to apples comparison. There are just different strategies that one could employ in order to grow their family bank. The last point that I would put on this before I hand it over to Eunice is that we all have financing needs. We all need to purchase something. If it's a new vehicle or something else, we have financing needs. The question that I ask is whether or not, if you're going to build your family bank and have interest be paid there, or whether or not if you're going to give that to one of the commercial banks and have it paid to them. Final point is that if you pay the interest to the mutual insurance company, they're going to pay you a dividend, which then helps with your family bank and its growth. So that's the last misnomer that I have out there.
What are the potential risks of relying solely on a 401k for retirement? And how can whole life mitigate those risks?
I don't think that people are forecasting a degradation in their lifestyle when they retire.
No.
And that plan of leveraging your 401k means that, right? So even if you were to take out your distributions at 59 and a half, which is what you have when it comes to your 401k, If you're still working, that's going to be additional income that you're going to be taxed on. So if you go to the book 401 Chaos, he puts forward an argument that it is best not to invest in your 401k for a couple of simple reasons. One, you can't have access to those resources until 59 and a half. If you need to access or tap into those resources, you can take a loan, right? But if you somehow terminate from that employer within a certain time frame, that loan must be paid back immediately. Otherwise, it's going to be an early distribution. And with early distribution, there are penalties that go along with that at the same time. But I believe the chief argument that he put forward inside of the book is that although you are deferring paying taxes on a 401k, right? That 401k, if you were to take a distribution, will be taxed at your income level, whatever your W-2 level is, but it might take it even higher. So that's probably going to be 21 and above, right? However, if you were to take a distribution from your insurance policy or a loan from your insurance policy, that is typically going to be between, well, whatever the rate is at the insurance company, but that's around 4 or 5%. Mm-hmm. And Elon Musk just showed a reason why you do this is because he didn't sell his Tesla shares. He took out a loan against his Tesla shares. And that's what our community needs to learn how to do, is leverage those assets while you are still in control of that asset. Too often, the family home gets sold when grandma is no longer with us, right? That house should stay in, because that house, once it's paid off, it's a source of cash that can be leveraged to grow. So 401k, he basically put forward the argument that you would pay taxes at plus 25% if you were to take an early distribution. And the reason why he's saying, if you had invested that money, right, capital gains is, if you have the asset held for longer than 1 year, is 15%. So you now got to compare 25% versus 15%. So he puts forward the whole entire argument, and then it starts to make sense as to why you might want to go over here versus going over there. At the end of the day, it may not be right for that individual, and that's okay, right? But for those who understand it, and it falls into their plan for where they want to go, then come on, there's an opportunity to come along with us on this journey, because we find value in it.
What's the biggest warning for others who want to set up a bank on yourself type of policy the right way?
Well, this is the analogy that you have to put forward in front of people. They're giving you that 0.01% interest. But if you go to the bank and say, I have a need for a loan, they're going to charge you 7%. So they're only giving you 0.01. But if you need access to funding, they're going to charge you 7%. That arbitrage is in their favor. It's always going to be in your favor. So this is to say, well, rather than banking on Bank of America, right, I want to have the Pendergrass Family Bank, right? And you set up rules around that family bank with the family on how those funds will be used, right? So this way you're having that conversation with your daughters, and you're saying, this is how we use this bank. One of the points that you talked about, because we got into this and we used a third party. That third party didn't set us up correctly. After 3 years of funding our bank, we were like, this thing is not growing cash value. What is the problem? That person had set us up with a policy that grew its death benefit at the expense of its cash value. So one of the points that we need to touch upon today is deciding on what type of insurance company you have to use. There's a mutual company, and then there's a shareholder company. You just have to X out shareholder company because the dividends at a shareholder company are paid to the stockholders. With a mutual company, the dividend is paid to the policy. The first critical thing that you need to know about setting up your own bank, mutual company versus shareholder company. The first thing has to be, you need to be with a mutual company. And there are experts out there who can set up your bank incorrectly, which would be to your detriment. And that's the reason why my wife went and got licensed so that we could understand this fully and be able to share with others our learnings so they can leverage our mistakes and not make the same ones that we made.
What is the difference between direct and non-direct recognition in a cash value life insurance policy? And why do you need to know that?
Okay, I could go on a whole rant.
We can go, and that's the thing about this is when you start having an honest conversation about this and the opportunities that it affords you, that's when you start to get excited about all of this, right? And the conversation has now transitioned onto taking out the loans, but there's also differences that you have to recognize with how the policy is set up. Is there direct recognition versus non-direct recognition, right? Because we said go with the mutual insurance company, right? But the next layer to this is whether or not if there's direct recognition versus non-direct recognition. So with direct recognition, when you take out the loan, your cash value level is reduced by the amount of the loan, right? If you have $50,000 and you take out $30,000, your cash value is now going to be at $20,000, right? So that's direct recognition. When you take out the loan, the cash value goes down. But with non-direct recognition, when you take out a loan, if your cash value is at $50,000, it stays at $50,000, right? That gets you excited because you talked about the double dipping play, right? Now I'm earning a dividend on my cash value, right? But I've taken out a loan and I now have it invested in some other investment vehicle. So let's use the analogy that got me excited when I saw your podcast was like, oh, I could turn this into Toro, right? So I could take out $25,000 from my cash value policy and I can put that onto Toro, right? And if I have a paid off vehicle, right, all of the monies that I get from Toro are now just on top of that. I could use that as an arbitrage to pay back the loan, or I could use that money to go and grow my Toro fleet. But that's just one opportunity. And as you mentioned, you took out the loan so that you can buy a value add cash flowing property. There's another arbitrage at the same time. But if you haven't started your own bank, you can't even have that conversation.
Yeah.
Oh.
Right? You're not even having that conversation of arbitrage and how it is that you could actually leverage. But this is one of the reasons why our mission, our passion, and you could probably see that we get excited about this. I don't know why we get excited about this, but this is something to get excited about because banking in and of itself is probably a very boring, stale, dry topic. But once you start to understand this thing, you could get excited about it because then you start to see the opportunities and how you can use it for your family. And that's what matters at the end of the day, is what are you leaving for your family? What kind of legacy are you creating?
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.